whole screen, and then we're just the little cells up on the top on the right-hand column.
Great. Okay, well, I'll just dive in. I'm Kris Moe. I work with M&A business advisors, and we're kind of, as business brokers, we're kind of a quarterback in all this and helping guys exit their business. And so it involves, both sides being able to get financing. It's even considering tax strategies with financial planners and so it's pretty darn complex. So it's nice to be part of a firm that has people with lots of experience, because there's so much to know, frankly, that it really isn't possible for one person to know it all. And that's why we have specialists like Chad on here, and tax attorneys and real estate attorneys. It can get pretty complex. But what I'm going to talk about in this is basically mostly about valuation and maybe some of the tricks along the way and what to expect in the due diligence. And along the way, Chad, you're going to be always welcome to jump in with your expertise, because I know there's a few things about PPP that we'll get into. But Chad he works for Exchange Bank. He's up in Santa Rosa, and he and I have become friends over the years. Play golf once in a while, and so that's been really good. And so whenever I have questions about what's going on with lending, Chad's my guy. And quite often I at least send someone who needs a loan, I send Chad's way for at least some consultation. So that's great. So let me just move forward here. So for anybody, I'm learning more and more that you don't just, in the last year, like, okay, I think I'm going to sell my business. Ideally, this planning should be taking place years and years in advance. And only because experts that are on your team, again, the financial planner, these guys that are experts in helping you get the most when you do sell your business, basically make the right decisions along the way. So, Chad's on here because sometimes people are looking to acquire a business. Maybe you're 40 years old and you're 20 years out from retiring, and for you to reach your goals, you might have to acquire a business or two along the way. So it's not just selling to retire, it's maybe selling to grow. So that's something, in working with your financial planners, like, hey, I need to retire with $3 million. What do I got to do? Well, Bob, your business right now is you're only making 200,000, You're only going to be able to sell that business probably for, double that. So that's kind of what we're going to get into is, preparing for success. And the barometer on that is one of the first things to do is get a valuation. What's your property? What's your business worth? And basically, well, these are the steps to pre-marketing a basic business is, and the due diligence part is what to expect. What are the buyers going to ask you along the way? And that's kind of what we're going to coach you to do. And we can talk a little bit about that. Along the way, we're going to package the business, and that's going to be basically your lease situation, how much money you're making, your equipment, all that stuff is going to be put into a package eventually, because the buyer ideally is going to have all those questions answered, and whatever's not answered, phone calls or visits are going to fill in the blanks. And then along the way, you want to just make sure your team's in place, not just your advisors, but the people working at your company, your number two and the key people. That's going to be part of the transition. If you're the top dog and you do all the work, as soon as you're gone, that's going to make for a pretty complicated transition and maybe create some friction along the way.
Hey, Kris.
Yeah, dive in.
All those lines of like the valuations, like going forward, I know this year is unprecedented, and probably next year to maybe the beginning of the year, when you're looking at valuations, at least from a lending standpoint, we want to have monthly profit and loss statements for this year, so that we can see, or the evaluators can, and you can evaluate to see how the business was negatively or positively affected by the COVID. And an annual, a cumulative total profit and loss may not tell the story, but by monthly profit and loss statements really helps for evaluation for at least for this year, maybe into beginning of next year.
So probably, the trade guys are a handful of the industries out there that hasn't been that affected by this COVID. Are you seeing anything on your side, or are things dipping
Not on the trade side. I mean, it's it's the typical, it's the gyms, the hair salons, the hospitality, the restaurant side. Those have just been hammered by this. But there's a lot of the transportations, the hardware stores, the professionals, the trade sides. They've all done very well. They're all up. A lot of them are up more than last year.
Since we're in this pre-market thing, what would you suggest to people who are thinking about selling their business or getting ready to sell their business? What do you as the bank, what do you guys like to see kind of just a quick and dirty of kind of the main things you like to see in place?
Well, I mean, it goes back to when you first said about trying to sell your business. You've got to have a long-term plan. Like, you don't just wake up today and say, "Hey, I'm going to sell my business." You want to be able to set it up, work with your CPA, your advisors, because in the end, a lot of business owners are trying to do tax savings and maybe not report it all. But as a lender, we can only lend what we see on paper. And so if we're trying to minimize the tax hit on the business, then that will reduce the lending capability of that business. And we're only going to lend what we see on the tax returns. So that's something that you want to plan ahead, a year or 2 years from now, to say, okay, I might be taking a tax hit on this, but I'm going to be able to sell my business for a lot more because I'm reporting the true income of the business.
And that's a perfect example. Everybody is some people like to hide their money in the tax returns, but as you're getting close to selling it, the more you can show on your tax returns, lenders love that because it's very clean.
Yeah.
A lot of times the things I like to try to add back, the Chad or one of the other banks will be like, no, that add back's not going to work. And by the way, an add back is like paying your wife $150,000 for, and she's coming in 2 hours a week. That would be an example of that add back's pretty questionable. I mean, what would it really cost for somebody to be doing that job? What would be the fair market value? And sometimes they might not even allow that recast or that adjustment. So they like to see what's your profit in your tax return, what are you paying the top officer, the seller, and they usually add those up. And do you guys factor in appreciation and interest, or do you not even include that?
Yeah, no, we'll look at the interest expense because in theory you're buying a business that is going to be debt free, other than maybe a loan to buy the business. But you're assuming it's an asset purchase. You're just taking over the business, and you should have all the loans that were tied to it should be paid off through escrow. So yes, we'll add the interest expense back. Depreciation is a different story. We generally will add 100%, but when it's certain industries are heavily involved in revolving equipment. Let's say like trucking industries are always buying trucks every couple of years because they've just got hundreds of thousands of miles on those. So there's always going to be that depreciation expense. So in those type of industries, we'll add probably 80% of the depreciation expense back. Any other maybe one-time expenses, maybe they in these such industries, maybe they're looking to there's a patent, or they've got there was a lawsuit, a one-time hit to the legal side of it. We can add that back too, because that's not a reoccurring expense.
Yeah, I like that. So basically, this is really just a different kinds of valuations. You can pay a professional appraiser. I mean, sometimes, let's say for a divorce or a partner buyout, it's a good idea to probably get a professional appraising. The one I'm going to talk about is kind of we call it a broker's opinion of value. So it's usually a wider range. We charge typically $1,500 for that valuation. A professional appraiser is going to charge you between, say, $3,000 and $10,000. And like everything I'm going to mention on this, we have referrals for everything from SBA lenders to financial planners, or if you're in a jam with, or you want something restructured in your corporation, is people who focus on that. What I'm seeing is a lot of sellers will end up relying on, the CPA they've been working with for 25 years. And it's not a bad idea to get a second opinion from another CPA. Not every CPA stays up with the latest tax laws. These tax laws are changing every year. And so you could be leaving money on the table if you're not with the person staying on top of the latest goings on. So that what I'm looking for is 3 to 5 years, 3 years of historical tax, so tax returns and your P&Ls. The valuation method is mostly going to be a market valuation, very similar to real estate. I used to be involved with real estate appraising, so it's pretty similar. Is you're getting comparables, and that's what we're going to get into. So I'm just going to move right into it. So when I get your tax return, what I'm looking to do is, here's 3 years. You got top line here, sales. You got cost of goods. This was a construction company, pretty good size. And let's see, we got, well, you got the net income, and then you see the depreciation. So this all added up with the salary of the owner. In this case, there were 3 owners, and they were paying themselves each $100,000. So this was a little bit challenging because of that, but I just put in 300,000 for the owner's salary. So taking the net income and then adding the salary of the owner plus the payroll tax on that, you can see over 3 years another challenge, kind of a discrepancy here. We don't need to get into the weeds on this, but let's just look at 2018. So his discretionary earnings basically was about $1 million. So SDE is basically including interest and depreciation. Larger companies oftentimes are looking at EBITDA. EBITDA just means you're not including the depreciation and amortization or the interest. So that's really the only difference. Do you have a preference on those, Chad, or whether you're doing SDE or EBITDA?
No, you're right. You're right on there with the SDE. And it's again, those are the basic ones we really look to add. I mean, they're easy because we have a paper trail to add those back.
Yeah.
Yeah.
So here are some of the samples of add backs. Your state taxes, okay, your personal health care. I think a lot of people run their personal health care through their business. These are added back to the bottom line. So let's say you're leasing a car for your wife or yourself. In this case, it's about $300 a month. This is being added back. In this case, I actually took the fair market value for, up here we were paying the guy $300,000. The fair market value for running that part of his company, I put in as $150,000. So actually, I made an adjustment here for this thing. So I took that off the add back. So in this case, it ends up being kind of a negative because they are overpaying themselves. Sometimes owners are overpaying themselves, and that gets adjusted, or they're underpaying themselves, and that'll be what we call recasted. So that's what this is. That's what the broker is going to do for you. It's good to know what this is. This is so important, whether you're selling next week or in 3 years. What's my business worth? Because a lot of people they don't know about add backs. And it's good to kind of get a third party to do it and say, well, what the heck is this for? Oh, I didn't even think of that. Sometimes sellers miss these things, but oftentimes we need help in going through the P&L because it's, sometimes the descriptions aren't so clear. And so we anything I come across that's questionable, I'll say, hey, Bob, was this a personal expense? Is this something that was really needed for the business? If it's not necessary, it's going to be added back, because most likely the next business owner or the next owner of this business might not have that. It's part of the profit. So we want to account for all that. So this would be kind of an example of basically after I get the weighted average, the recasted spreadsheet or the worksheet. In this case, let's just say that last scenario, the business was making $1 million. It's a weighted over those 3 years. Chad, are you doing the same thing? You're weighting it over 3 years, right?
We do. We look at trends. We look at where we're lending on the business. I mean, are we lending on it? Are the average, is it flat? Is it increasing, decreasing? Is it fluctuating? It just tells us
So
your
for you
story.
guys out there, let's say you killed it in 17, as in you did great, and then your trending is going down. That's a red flag for both the lender and the buyer. Ideally, you're going out on a high note. Everybody loves to see increasing numbers from year to year. But at the same time, if there's a very good reason why things are going down, like COVID, then I think, and that's what Chad's going to get into on his slides, is, and there's kind of a way around that, and we'll get into that. But in this case, I put in search criteria for this valuation. I put in basically that the business was doing somewhere between $1 million and $9 million. I wanted a pretty wide range, because sometimes if you put in too narrow of a range, you don't get enough comps. In this case, I have 129 comps, and these are comps that were SBA funded. So that means they were pretty good books. If they pass the muster of the banks, it means clean books, good stuff. So usually the valuation on these will be a hair higher. There's just nothing fishy in these businesses. So the SDE, or seller's discretionary earnings, and right below it, the EBITDA, but we're looking at SDE in this case, was between 400,000 and 1.8. Pretty wide range again. Again, I was trying to get a pretty big net on this. But let's just jump down to here to the multiple of the SDE. So in this case, the results gave me a pretty wide range. Look at that, 1.18 to 4. But the average was about 2.85. So that's a pretty good range. So if I talk to a guy, let's say his business is making $500,000 SDE, I would say, his range would probably be about, he's on the lower end of the spectrum. I'd say 2.6 to maybe, 2.8. The reason why we give a range is because, let's say your business is doing $1 million. That'll always bring up the SDE. It's going to, $1 million sometimes can take it up to 3.5. And that's where it becomes, that's why it's good to sift through. If you look down here below, look at some of these businesses. Well, all these are $500,000, but the next slide, here's the business, a plumbing contractor doing $1 million. And you can see his SDE was 3.75. That's a really good example on sales of annual sales 5.2. So when I give somebody one of these comp reports, I want them to kind of understand how to go through it. Because if I gave somebody this who was making 400,000 in profit, they're like, hey, well, Kris, I should be doing, at least 2.85. That's what you said. Remember, this is averaging in, businesses are doing, up to 9 million in gross revenues. Now, for that same seller, I would probably scrunch down the range on those revenues, but I wanted to share with all of you guys a pretty wide spectrum of what's possible. But
Hey,
yeah, go ahead.
Kris, how do you factor in, especially in like maybe these industries, they're going to have equipment, they have machines and trucks, vehicles. How do you factor that into the value as well?
That's a great question. Because let's face it, some owners are going to be every year to not pay as much tax. They're going to be buying new equipment every single year, and that's a good thing. And that's the part with working with your financial planner or tax planner. at what point do you actually stop buying the new equipment, saying you're going to be, selling your business in 2 or 3 years? Because you don't need new equipment every single year. So obviously a buyer is going to love it if you're passing all that new equipment. However, all that equipment, the way we look at it is that's not over and above the cost of what the buying price is going to be. It's what is making the business functional. It's part of what's generating the income. So let's say you say, well, I'm just going to sell all my equipment. Well, if you're selling all the equipment, the business, for the most part, is not really a functional business anymore. How are your guys going to get to the job? What are the tools the guys are supposed to be using? So you want to keep a reasonable amount of equipment that's going to keep the business running. So that would be a red flag for the buyer if they saw, oh, wait a second, last year you had like $500,000 worth of equipment. We saw it on the balance sheet, and now we're seeing there's 100,000. What the heck happened? So your answer could be, hey, it's still our business is functioning fine. This is part of due diligence where the buyer is going to verify everything. And so ideally everything is ship shape, financials are clean, inventories are at the levels they're meant to be for, the buyer doesn't want to come in and have to buy all new door openers and all the different things and start from scratch. You have to leave them with a reasonable amount of inventory so they can hit the ground running. Essentially, you should be running the business the way you normally do until you hand over the keys. That's like the key. So anyway, for this business, I would basically, I'm just going to keep it simple here. I would say, hey, our report is you're going to probably be, for your $500,000 business, probably in this scenario with these comps, you're going to be in a range of somewhere between 2.5 to 2.9. And at the end of the day, that's a pretty darn good range. And this is where I have to qualify everything is you can follow all these wonderful formulas of how to do valuation. At the end of the day, it's what's the market. It's kind of luck. If you happen to put your business on the market when there's lots of buyers, you're going to get a higher valuation for your business. If it's at the wrong time, so you want to time the market. Can you time the market? Sometimes yes, sometimes no. If someone's sick in the family and you have to sell the business, you don't have a choice. But if ideally you're being patient, you can kind of time it when your business is doing well, which is great. And also the market is strong. There's a lot of people acquiring, strategic buyers and that type of thing. So sometimes I might give a range and someone might pay more than that because they want your business that bad. So that's ideally what you're doing. I'm going to skip through this right now. It's not that important. Why are you buying a business? Well, you're growing the business because you want to sell for a higher multiple. Again, if you buy somebody else's construction business or door installing business for $500,000 or $1 million, you just added to the revenues and everything else. Your valuation might go from 2.5 for your own business. You just turned it into a 3.5 business. So that's partly why you want to grow the business, aside from gaining the other company's equipment and inventory and its location and all the other things you see here on this list. So and customers, obviously, as I'm going down this list. So I'm going to turn it over to you, Chad. I'll let you just start going down the list and I'll look and see if anybody's got any questions to this point, but I'm going to turn it over to you right now and talk about how COVID and what's the latest in the SBA situation.
Yeah, it's very fluid these days, Kris. It seems like it changes day by day with what we're supposed to be looking at going forward, how we're supposed to handle the PPP loans. And let's face it, I would say majority of the businesses out there, small businesses, receive some kind of government assistance, whether it's the EIDL loan or the PPP loan. But sticking with this type of industry, If you're looking, if there's a buyer for the door installing business, the SBA always looks for what kind of experience level does the buyer have. If they're completely green, really raw, and want to get into this, it's going to be kind of tough. The second bullet point down there says a possible RMO, RME. These are responsible managing officer, which would be the seller, and there's a responsible managing employee, which would be the buyer. And so what that means is that they would put together a list, a kind of an outline of how long is it going to take to get that license. And they have 1 year. You have 1 year to get that license in place. That's kind of general hard and fast rule for SBA, because the seller cannot stay on as an employee for a year. They can only stay on as a consultant. So if you think you're selling your business and you want to just stay on, that's great. We actually like that because it helps the transition into new ownership, but you can only be on as a consultant basis. So, but looking at a buyer that wants to buy this business, they've got to have some kind of experience, and they have no experience at all in that industry. The RMO and the RME option is probably not going to work. If they're from tech and they're coming into doing this because there's great income to be made, probably not going to work with that. But
Yeah.
if they've been in the trades for a while, they don't have that license yet, but they've got that experience level, hands-on, then that's going to work. And by putting that outline together, when I'm going to take the classes, what date will I be taking the test? Those are the things we would need.
Well, I know I sent over a guy to you who had 20 years in HVAC, and he was he didn't have his license yet, but he was looking to buy a plumbing company. And how did that work out? Because obviously he's got his journeyman experience.
Yeah, absolutely.
He hasn't taken his test, but he says he can. He just hasn't. So how would you treat that?
Yeah, that's a perfect example of how we could do the RMO, RME option, because he probably has more experience than 90% of the people that we lend to, because he's been in the field. He understands the trade. He understands the process. He just doesn't have the license yet. And so by setting up the RMO, RME, where you operate under that seller's license until you get your license, I think he's a perfect candidate for that. But the opposite side of it, if you just say, hey, I look at this business and it's paying these sellers $300,000, I want to buy that business, and they have no industry experience in that particular field, that would be tough. It'd be tough.
Hey, so boy, am I jumping the gun here, but
that's okay.
I know the PPP thing. I'm trying to sell a business, and I'm sure almost everybody on here has basically got a PPP. Right now, it's getting in the way of those people selling that business, because we're assuming that those loans are going to be forgiven under 150,000. What have you heard lately about it? I know your bank is doing something to try to expedite that process. Can you share what that is?
Well, yeah, and again, this is a fluid daily conversations that the SBA is not giving us a lot of feedback right now. I mean, they constantly have been changing the guidelines for the PPP. Even when you first applied for the PPP, it used to be 75% of the balance had to be used for payroll. Then they reduced that down to 60% of the balance had to be used for payroll to be completely forgiven. We're hearing a lot of different reports of it, whether or not 150,000 or less will be completely forgiven, just a one-page document, no supporting documentation. That's the rumor we have right now. We're doing some test samples right now. In our bank, we bought this software. We're working with a third-party vendor that when you are ready for the forgiveness, you log into our portal, put in some information, and then the computer system, the software system actually will do all the work for you. So we're doing some testing actually this week for that. We just took a handful of PPP clients and we're looking at that. But Kris, it's constantly up in the air right now. I mean,
yeah, this is being recorded, so by next week everything might be different.
Yeah, yeah,
That's how
it's true.
quickly it's
Yeah.
moved.
Today, August 21st. Yeah.
So what we're doing, we're doing 3 deals right now that we're actually closing, that even though the sellers got, half of the sale price in PPP, what they're doing is they're putting it in escrow. And so if it's forgiven, the seller gets all that money back. If it's not forgiven, then it's earmarked to go to repay the loan.
Yeah.
So that's what our workaround is right now with some certain of our deals.
Yeah, I think it's with again, and we're going to see a lot of these in the next, few months here with the PPP. And depending on how the structure of the transaction is, if it's an asset purchase or a stock purchase. Asset purchase, the PPP stays with the corporation and it stays with that seller. There's no obligation from the buyer to pay that. So that will stay with the seller at that point. If it's a stock purchase, then the buyer is acquiring everything, and you hope that the seller has good paper trail that then can help get that loan forgiven. If it's not forgiven, let's just say that part of it is not forgiven. Maybe part of the PPP loan is not forgiven. We have to factor that into the cash flow of the business, and that may or may not affect the business for that. You're going into, leading into the COVID, and what is going on for this year and really next year too, for the beginning at least, is we want, if you're looking to buy that business, even though it has historical cash flow, it's been around for 20 years, SBA always requires a buyer to put it together projections, because they might have, you might have run that business solidly. If it's not broken, don't fix it, right? But there might be a buyer that comes in and says, you know what, I see this is another avenue that I can, another, call it sometimes a side hustle, that I can see another avenue of revenue by doing this. We want to see that, and then we want an assumptions page that tells us how you're going to attain those projected numbers, hours of operation, marketing, new product line, competition. Part of it this year too is a COVID plan, and what that means is that maybe the business isn't operating at 100%, maybe it's at 80%, maybe it's at 50%. Part of the projections will dictate that, will show that, and it may not be fully open until next summer, until there's a vaccine. And so we want that reflected in the projections, but also on the assumptions page, which again is like a blueprint of how you're going to get to those projected numbers. So we want to see, if you're only operating 75%, what does that look like? Where's the break-even point too for the business? We want to see, if you're not operating at 100%, fine, but we also want to see, where's that break-even point. Another thing too is that going forward, we had to have a COVID questionnaire. It basically is like your acknowledgement that yes, there's something going on. Yes, we understand that their business may be negatively or positively impacted by this, but there's a questionnaire, and you just basically answer. I think it's 8 or 10 questions up there. And what I mentioned earlier on about like valuation is that buyers, lenders, and business valuators are going to want to see monthly P&Ls from January through right now, probably June or July. So we can see if the business was negatively impacted or not. Maybe there was rent concession, there was a drop in payroll from say March to June. We just want to see those kind of numbers. We might actually want to look at it compared to last year at this time. So we take the first 6 months of this year compared to the first 6 months of last year and say, okay, yes, it was negatively, or no, maybe it wasn't. And so, because maybe it's seasonal. Like, in these industries, there could be some seasonality to it, and it doesn't, the numbers, and a P&L may not reflect that. But if we look at it last year's, the same period, we can actually then make a case for it.
Cool. Okay, so basically, I told everybody we'd keep this about 30 to 40 minutes, so I'm going to try to wind this down, because the most important things we've been talking about is just get an understanding of how professionals are evaluating your business. It's not rocket science. It's not unlike valuing your house or a property. So then, kind of getting ready to sell your business. Again, if it's within a month or if it's 10 years away, getting a good team of people around you to kind of coach you to making good, tax planning decisions, good, retirement, savings, I mean, all these type of things. Should you be buying new equipment when you're looking at selling in 3 or 4 years or whatever? And so this part's about due diligence. Part of what we're going to do as a broker is basically get you prepared for what's going to be needed in the due diligence process. So I try to send out lists and things and say, hey, here's what's coming up. You might as well start getting your leases, in order, so the buyer can look at those. Because sometimes leases are 70 pages, and I got to read through all those. I mean, there's all kinds of fishy things that landlords put in there that can, frankly, blow up deals. So leases are big. The financial side of it is huge. And, that's just to due diligence, get your finances as clean as possible. Ideally, it's just the tax return that needs to be seen. People want to eventually see customer lists and are your vendors going to be in place and all those type of things, the age of your trucks and your equipment, and that's all going to be part of due diligence. Start getting it ready. Even if it's 3 years away, just go through the exercises like cleaning out your closet, just so it's not going to be a huge job when you decide to do it. So, and again, that's what we do, is we kind of get you ready for knowing how to prepare for that.
Hey, Kris, can I add on to that? You use like the due diligence, absolutely. And I think, if the business is heavily concentrated on, like, say, 1 or 2 accounts, it might be a good time to start diversifying more and branching out and getting more accounts, because you lose one, that could really affect the revenue. Even if you're not even selling, you still may want to think about diversifying and getting additional accounts there, because that could happen, and you just want to make sure that you're setting the business up for success.
Yeah. So everybody, thanks for chiming in. Chad, thanks for your help. Chad is great. Again, he's very responsive, knows his stuff. He's been doing this for a long time. Great guy to call for talking about an SBA loan. And again, thanks for checking in. And if you have any questions, you can see Chad's email there and mine as well. And feel free to just go ahead and contact us directly with any other questions you might have. So thanks again. Stay safe and enjoy the rest of the summer.
Thanks, Kris.